Hello there. I hope that you're doing well. Welcome to this new lecture of the 2025 model series. This lecture is going to be on SMT, Smart Money Time. First of all, before we dive into this lecture, I would like to share with you that SMT is a confirmation tool, nothing more. Meaning, SMT is not a tool which you utilize to simply determine bias. It's not a tool which you utilize to determine where to buy or sell. SMT is merely a confirmation tool of your existing analysis being at play. Smart Money Time. Let us define what SMT actually means. SMT gets looked at after the prior steps of a protocol are present. Meaning, within this model series, you have been introduced to concepts in a specific order. SMT forms in this order, meaning the prior steps first need to be present before we even consider looking at SMT. If this is not clear to you, don't worry. Down the line within this series, I'm going to show you the full protocol during a separate lecture. Because SMT only gets looked at when the prior steps of the protocol are present, we must only look at SMT as a confirmation of the prior existing steps of the protocol. Meaning, SMT functions as a confirmation tool of our process indeed being in play, meaning our focus is on detecting reversals and SMT confirms to us that the reversal is taking place. There are multiple forms of SMT and during this lecture I will share multiple with you. First of all, we're going to be paying attention to the following form of SMT. This SMT forms over a larger time cycle, and what you can see is that on these two markets, you can see that they are highly correlated. However, the market on the left right here created a high and then saw the market retrace. What happens between this retracement leg and eventually the lower high which gets established doesn't really matter. Meaning the market can just consolidate, it can drop even lower, doesn't matter. Therefore, I've labeled this as irrelevant price action. What you can see on market 2, however, is that market 2 also forms that first high and it then eventually creates a higher high. This means that market 2 created a higher high whilst market 1 created a lower high. This is SMT. Therefore, this is a Kraken correlation between these highly correlated markets, and when this is present, this tells you, alright, we're likely going to see the underlying order flow change soon. Now, it's important to note that whenever we are paying attention to these swing points, we must blend this with the time cycles. Meaning it's not just a current correlation and therefore the market is now expected to turn around. Nope. It is all paired with the logic of the time cycles as I've shared them with you prior during this series. Meaning we focus on the open of a new time cycle and then we pay attention to the previous cycle high. If one market doesn't take out the previous cycle high whilst the other market does, that is a time cycle SMT. When we pay attention to a chart example of this then, what you can see is that on the left you can see the Nasdaq and on the right you can see ES. What I would like you to see is that Nasdaq formed this high right here and we then saw the market reprice towards the upside. Notice that the market came very close to taking out this high, but the market just fell short of it. If we pay attention to ES, however, what you can see is that ES took out that same high right here. And therefore that shows to you, hey, this is actually a correct correlation between the Nasdaq on the left and ES on the right. Where ES created a higher high, Nasdaq created a lower high. And that SMT set up the reversal which followed afterwards. When we pay attention to a bullish example then, the bullish example looks like the following, where I can see that market 1 creates a low right here. Then we see irrelevant price action. Again, it doesn't matter what happens between here. All that matters is that we form this low. Then a new time cycle opens up and we see the market eventually create a higher low relative to this previous cycle low. If we however pay attention to the market on the right, you can see that the market on the right also forms this low and eventually creates a lower low. Therefore, that's a correct correlation relative to this low. But in particular, it's a current correlation relative to a previous cycle low. So that's time cycle SMT. Now, I understand that for some of you it might be confusing what I'm labeled here, irrelevant price action, but what I mean by that is that price can literally do whatever it wants to do. Meaning it can consolidate, it can expand, whatever. It doesn't matter. What matters is that we see a new time cycle open up and on one market create a lower low relative to the previous cycle low, whilst the other market creates a higher low. That is the importance of this SMT. When we pay attention to a chart example then, what you can see is that on the left, we can see that the Nasdaq formed this low and we saw the market expand higher. Eventually a retracement occurs and we see the market form a higher low relative to this low. If we however pay attention to ES on the right, what you can see is that ES also formed that low, expanded higher, and then eventually took out this low, whilst Nasdaq didn't. And that is a SMT, relative to again a previous XL. Now, what is very important to note is the following. Everything which I'm sharing with you during this lecture is fractal, meaning this works across all time cycles. Whether you're looking at monthly cycles, whether you're looking at weekly cycles, whether you are looking at daily cycles, whether you're looking at session cycles, whether you're looking at 90 or 30 or even 10-minute cycles, it's the same logic. And it shows to you that the time is fractal. Now, when we pay attention to another example of SMT then, what I would like to see is that market 1 on the left right here creates a higher high. Market 2 on the right here creates a lower high relative to this swing high. Now, this is your regular form of SMT, as the majority of you are probably already familiar with it. But it's important to note that even this SMT is also a time cycle SMT, but it forms on a smaller scale. Every single market reversal either forms with a breaker formation, as you can see on the left right here, or it forms with a mitigation block formation, as you can see right here on the right. There's always either a breaker or a mitigation block. Now, when we pay attention to a chart example then, what you can see is that on the left you can see that the Nasdaq expanded towards the upside and it formed this high. Eventually, multiple higher highs formed relative to this high. First higher high formed right here, and eventually second higher high formed right here. Notice, however, on the right that we did not see ES take out this high, which is annotated by this red line. Meaning ES created lower highs, whilst Nasdaq created higher highs. And that is important to note because that shows to you that Nasdaq and ES had SMT present right here. Now again, SMT by itself doesn't mean anything. However, because you're anticipating a swing high to form, that is when that SMT begins to hold a lot of significance, because that shows to you that the time is right for the underlying order flow to begin changing from buy program to sell program. Now, when we pay attention to a bullish example then, what you can see is that this is literally the same schematic but then in first, where I can see that market 1 on the left creates this low, and we then eventually see a retracement taking place, and then a lower low gets created. Notice, however, that the market on the right also forms this low. We see a retracement taking place, and the market creates a higher low. The correct correlation is present relative to these swing points, and therefore that shows to you, alright, we're now going to see the underlying order flow likely change. Why? Because you're already anticipating a swing low to form, so this SMT serves as the confirmation of that existing idea. Again, here we are looking at a chart example, but before we discuss the chart example, I want you to understand that this SMT also takes place relative to smaller time cycles. And what I would like to see is that on the left you can see that the Nasdaq formed a low right here, and on the right you can see that ES also formed that low. Notice that ES, however, formed a lower low relative to the low which I have annotated by this red line, whilst Nasdaq formed a higher low, and that is that correct correlation which we have just seen within the schematic. Another form of SMT has to do with opening times. This is a more rare variant of SMT, however, I still find it important to share with you, and the reason why is because especially when it comes to anticipating price swings, this is an important concept to understand. So, for example, when it comes to anticipating a low resistance security run, or for example, when anticipating that the underlying order flow might change when you're in a position, it's important to pay attention to key opening times. When it comes to key opening times, I'm referring, for example, to a weekly open, a midnight open, 9:30 open, or even every single 90-minute cycle is open. Each one of these opens has to be monitored when it comes to an intermarket relationship perspective. And the reason why is because by looking at intermarket relationship relative to the opening times, you're able to see whether or not cracks of correlation are present. And whenever there's a crack correlation present, that's usually a sign for either a deep retracement to occur or consolidation. What I would like to see is that on the left, you can see that the market expands towards the downside, forms this low, retraces higher, then expands lower once more. Notice, however, that the market did not reach this key open. Instead, we stopped right in advance of it. When we pay attention to the market on the right, then what you can see is that the market expands towards the downside, forms this low, retraces higher, and this market does reach that key open. Where market 1 did not reach the key open and stopped right in advance of it, you can see that the market 2 actually reached the key open and then begin turning around. So whenever you see SMT relative to a key opening price, pay attention to how the market is likely going to react off that level. And whenever you are in, for example, a short position from up here and you're riding the markets lower, be sure to take partials accordingly when you recognize this form of SMT. The amount of times that I was in positions and I saw open SMT taking place and the market just turn around and immediately begin retracing deeply is a lot. And therefore, I made the rule for myself, whenever I recognize open SMT, that is a key warning sign. And that's why I'm sharing it with you. When we pay attention to a chart example then, what I would like to see is that we are paying attention to the weekly opening. Now, the weekly open is shown by this orange line right here. And on the left, you can see that the Nasdaq tapped this weekly open multiple times within these boxes right here. If we, however, pay attention to ES, you can see that ES did not reach that weekly open. Do you see how the market reacted off that weekly open on NQ? Do you see how the market expanded away from it multiple times? Right there. Do you see that the fact that ES did not reach this weekly open is a big warning sign if you are in shorts, because it shows to you that we're likely going to continue the bullish order flow. There's a rush for ES to get somewhere, and that will also mean that Nasdaq is likely going to follow, being repriced towards the upside. So again, weekly open SMT is a result of market 1 reaching the weekly open whilst market 2 doesn't. Now it's important to note that when it comes to all of these different forms of SMT, that they can be blended. Yep. When we pay attention to a bearish example then, it's simply the bullish example in first, where you can see that the market expanded towards the upside, stopped in advance of the key open, retraces, and then we see another expansion leg higher taking place. Notice, however, that the market does not reach this key opening price, and instead we see the market roll over right here. Market 2, however, also expands towards the upside, retraces, and then expands higher once more, but it does reach that key open. Meaning market 1 did not reach the key open, whilst market 2 did. And the reason why that's important, because that is open SMT, but now within a bearish schematic. When we pay attention to a chart example, what you can see is that on the left you can see Nasdaq again, on the right you can see ES. Notice that we see ES reprice into that orange line, which represents the weekly open. Notice, however, that Nasdaq did not reach the weekly open and stopped right in advance of it. This is an important warning sign like I outlined. Now, in these schematics, in these examples, I've shown to you the hourly chart and I've shown to you the weekly opening. However, the same logic applies to those smaller opening times as I mentioned them to you. Even, for example, to, let's say, a monthly open or a yearly open. It's the same logic, just using a different opening price. Now, as a final schematic for this lecture, I would like to share with you the following. What I would like to share with you is that I have put the first 2 SMT schematics together within this slide. And what you can see is that on the left, you can see that schematic where I outlined to you the bigger time cycle SMT. When it comes to this time cycle SMT, this SMT can be, for example, relative to a daily low. Or, you know what? Let's say a session low. Yes? Let's say that this is our London low right here. The market eventually does whatever. This is irrelevant price action. And then throughout the New York morning session, we see the market open low, and we see it make a higher low relative to that London low. Inside of this SMT, which is being established right here, followed by this expansion higher, you are going to see on the lower time frames a lower time frame market maker buy model. Now, what I prefer to see within that lower time frame market maker buy model is the following. Within the low formation of that lower time frame market maker buy model, I prefer to see a smaller time cycle SMT. So where we have a session SMT, I absolutely love it when I also see, for example, a 30-minute or a 10-minute or even a 3-minute cycle SMT present on the lows right here. This is a smaller time cycle SMT. So what you can see is that in this circle, you can see that schematic of that smaller time cycle SMT. But I love to see that inside of a bigger time cycle SMT. And this is what I refer to as double SMT. When I see double SMT, that's to me a great confirmation of, alright, we have likely formed a low, it's time to buckle up for expansion higher. When you look back at the chart examples which I shared when it comes to these two big time cycle SMTs and small time cycle SMTs, I want you to pay close attention to them because you might notice something when it comes to the chart examples which I've outlined. When it comes to SMT, it's important that you train your eye for recognizing SMT because you must be able to see these correction correlation between these higher correlated markets. If you, however, want to automate this approach and you want to save a lot of time and mental hassle, etc., try out the SMT detector because the SMT detector saves you the effort of having to go out and pay attention closely to what both markets are doing. It simply shows you whenever there's SMT present. But again, SMT is merely a confirmation tool, meaning without all of the prior steps of this process being in play, the SMT means nothing. Therefore, SMT can only be looked at as a confirmation of an existing idea. With that being said, this lecture comes to an end. I hope that you found it insightful. I want to wish you happy Easter because it's Easter at the time of this recording, and I look forward to speaking to you in the next lecture of this model series. Be safe!